All right. So again, my name is Hendra Lau. You can call me Henry. And let's take a look at sort of the content of our presentation for today. So now, first of all, let me sort of briefly talk about the instrument that we cover in our service. All right, our website is elliottwave-forecast.com. Now, for all gold and precious metals, you can find, because we have three different groups that we cover, right? Gold and silver are being covered in group 1, okay, and then hello Robin. I think the audio is okay from my end. I think it probably is from your end. Why is it in and out? Because I think the rest of the attendees think they tell me that it's okay in the audio and video. Okay, and then for the miners, you can find it in the group 3. There's GTX, which is the gold miners ETF, and then also there's XME, which is I think less well known than the GTX. This is the US metals and mining ETF. This one includes some base metals like copper and so on, so it's not purely precious metals, right? So these are the two ETF related to the precious metals in the group 3, and then the gold and silver itself, the underlying physical metals, being covered in group 1. All right. Now, just quickly to also explain about who we are basically one of the leading providers of the Elliott Wave technical forecast. So we have a team of analysts in various backgrounds in finance and science. Me myself, I have a business background, and I basically had an MBA from Carnegie Mellon. Okay, and we've been in the business since 2005, the company. Okay, and we think that we are kind of unique compared to the other services in that we do not use just Elliott Wave theory in our model and forecasting, but we use couple of different tools like swing and sequence, cycle, and correlation, and this is what distinguishes us with the other sort of services. And in our experience, these additional tools that we use help us to sort of figure out the right side of the market. Okay, and I will explain to you more about this when we look at, let's say, gold, and I will try to explain my best and why we think that, for example, gold can still see further upside instead of topping out from this point on, because we are pretty active in the social media, and some people basically tell us about some alternate views and so on, and so this is the perfect time for me to try to explain our view on this. All right, let me show you. So our website is elliottwave-forecast.com. We have a lot of free articles, education, and so on if you are interested. Also videos. We also have YouTube channel. All right, and our YouTube channel is if you can subscribe to our YouTube channel as well. We got a lot of free sort of chart of the day and things like that. You can check out some of this. You can check out this video here, and then if you play it, you can see the link to our YouTube channel, and then you can subscribe there as well. Okay, so just a quick of information that if you want to get more information and so on, you can take a look there. We also have 14 days free trial. If you want to check our service, feel free, and there is no obligation for you to continue. All right, now let's take a look next. Alright, so before we start today's webinar, just a quick disclaimer here, right? And this presentation here basically is for educational purpose, and it should not constitute as an offer to sell or solid decision to buy any stock, currency, future contract, option, or any investment product, right? So if you are not sure about your situation, we suggest you consult to your financial advisors to get independent advice. All right. All right, so having said that, so let's take a look for today's webinar and try to answer the question on gold. All right, so this is the topics we're going to cover today. Gold's outlook. So is it a new bullish cycle or is it the end of the cycle? So we're going to try to answer this question. And then potential target for gold using the most conservative view of where it can potentially go. Okay. Now, number 2, we're going to take a look at silvers as well. and we're going to discuss gold to silver ratio and also the most conservative potential target for silver. Okay, and then we also will take a look at the gold miners and silver miners. Right, we're gonna look at some of the ETF that has some correlation with gold and silver, as well as some select companies that appear on the news lately within gold and silver sectors. Okay, and then finally we're gonna take a look quickly at the commodity sectors in general, because gold and silver also, even though they are so gold is some people call it monetary metal, right? So it is being sort of it's not purely commodity because it doesn't have any industrial use for it. People buy it for, central banks for it, and they store it as sort of monetary metals. People buy it for jewelry, which is also not really, you don't consume gold. So whatever you mine from the earth is going to stay above the ground and it's not going to disappear, right? But silver, for example, is 50% monetary and 50% industrial, right? So it has a little bit different characteristic. Silver also has a history of monetary use in the past. During the Roman Empire and so on, they used silver, right? But at the same time, it is also being used in the industrial. For example, a lot of electronics equipment, cell phones, laptops, electric vehicles, and so on. They need solar panels. They need silver, right? So in a way, they are sometimes being their category is being grouped into commodity, but then they have also monetary aspect to it. So I think the big theme this year and in the past few years has been this depreciation in the fiat currency, right? Because the central banks around the world, they keep printing money and providing a lot of stimulus, basically debasing the currency, and that's one of the reasons why precious metals being being strong as they are, because people are trying to protect their purchasing power, right, by basically putting in their money into precious metals, because precious metals, even though they may not produce any kind of yields, they don't give you dividends or interest, but at least over time they still maintain your purchasing power. So it's more like a form of money that doesn't depreciate, basically. Okay, so these are the topics for today. All right, now let's move on. All right, so here we go. So this is our monthly. So I think the presentation today is not going to be talking about the short term, right? So it's not going to be what can I do on Monday, can I buy or sell, and I want to close it for 24 hours. So we're not going to be talking about that. We're going to talking about the macro view, the larger point of view, and that's really the topic for today. Okay, so now let's take a look here, the monthly chart of gold. Okay, this is gold futures, GCF. So here we go. So this one has all the data all the way back to 1970s, right? As you know, we top out in 2011. The price was at 1920, I believe. I can take a look again to double check, but I think it's around 1920 was the high. All right, yeah, because it's a diagonal. It is a diagonal again. Now a lot of people always have this question and have this comment about, hey, wave 4, how can wave 4 overlap with wave 1? I can explain to you that is one of the most misunderstood rule about Elliott wave. Okay, and I can explain to you why that rule actually in practical terms is not very useful. Let me explain to you later on if I have enough time. But yeah, this is a diagonal. People can call it a diagonal when there is an overlap between 1 and 4, right? So when you have a 1, 2, 3, 4, 5, you need to understand that every 5 waves is always part of something bigger. You cannot have a 5 waves that exists by itself. It is always part of something bigger than that. So in this case, this 1, 2, 3, 4, 5 is a part of either wave A in the grand supercycle or a part of wave 1 in a grand supercycle degree. So you can have an overlap as a diagonal within wave A or within wave 1. You can also have an overlap within with C, within with C of an ABC, or within with 5 of a 1, 2, 3, 4, 5, right? So think about it. You can have an overlap within with 1. So this 5 waves within with 1 can have an overlap. This 5 waves within with 5 technically can have an overlap. The only time you cannot have an overlap is only within with 3 of the larger degree. You cannot have an overlap between 1 and 4. Okay, so in practical terms, it's really not, it's not really that a big deal, because you can always you know, as long as it is not within wave 3, you can have an overlap. It's a diagonal. Okay, so now let's take a look here. We broke to new high. By the way, we did a presentation on the gold last year. Okay, last year. And let me see if I can find it. Last year, here we go. We have this is the link. If you want to watch it from last year, I can send it to you, the link. Okay, I think I sent to all the link. I'm not sure if everybody received it, but you can watch this recording here. At that time, okay, I understand a lot of people believe that this move lower here in gold. Remember, last year we have not broken above 1920, right? A lot of people say that this move here is a 5 waves. This move from 1920 all the way to 1000, whatever it is, 1020, was a 5 waves move, and therefore they don't believe it's gonna go up. It's gonna break to new high, and they believe this is gonna fail somewhere in the middle and then go down and maybe go to $800 or something like that, right? And we argue last year, exactly, look at the date here, September 26, 2019, we argue that's not the case. It's not going to happen. We argue it is going to go up. And at that time, we use correlation as another component that gives us the conviction, right, that gold likely is not going to go another leg lower. Right, so like I said, we don't just use Elliott Wave, because as you know, Elliott Wave always has an alternative view, right? So then we use other tools like correlation, swing, cycle, and momentum, and so on. And from the additional tools, it can narrow down our sort of alternates here, alternate views, and then help us to figure out what really is the right side of the market. So you can watch why we think at that time, because at that time, the main reason we argue gold against US dollar should go up and break above here. At that time we were here. I mean, September 2019 we were here. Think about it. We were here at that time when we did the presentation. We argue it's gonna go up and break here, and it happens 1 year later, right? And the reason for that is because gold has already broken higher to new all-time high against all the other currencies, against the euro, against the Japanese yen, against the pound sterling, right, against the Australian dollars. So gold has already broken to new all-time high against all the other currency. The only currency it has not done it against is only the US dollars at that time. And we said, if gold is going to continue to go up against all the other currency, there's no way against US dollar it can suddenly go down by itself and go to $800, right? And no, we are not. We are based in the US, Lee. All right. And as a result, we are looking for gold against US dollar to eventually break to new all-time high, and it happens. All right. So let's take a look here on this view in gold. Okay, I do not have anything lower than this, the time frame. So we only have the monthly view. Like I said, it's not really going to be looking at the short-term view here, right? It's going to be very like a 30,000 feet kind of view, a bird's eye view here. We're not going to be discussing about short-term, or are we going to go down again first, or are we going to go up immediately, things like that. Now, for all the short-term, you can always go to our service if you want to know the short-term, but this is more like a long-term big picture overview. Okay, and let's talk about this chart over here. All right, Now you can see now, let me show you gold against other currency. This is the update. Okay. And gold against the euro here, right? It has continued to go up as we speak, and it has a, now first of all, gold against US dollars, right? If we assume this is an A and a B, 2011 high was an A and 2015 low was a B, then this is the most conservative target for us for gold in the next few years, which is the 100% extension, assuming ABC equal egg, right? That is the most hello Eric, that's okay, not really too late. This is the most conservative target here, 2,970, 3,428 is going to be in the 100% extension of the ABC. However, right, however, it could have been 1 and 2, right? We don't know, is it A and B or 1 and 2? It could be a wave 3 as well. Now, if it is wave 3, as you know, wave 3 is the strongest wave in Elliott wave theory, right? So potentially it can go to even 4,100 if it is a wave 3. But we're not going to speculate that high. We're going to be just assuming the most conservative view as always, right? And we're going to be looking at, okay, then our sort of conservative target is 2,971 target on the upside. Okay. So that will be sort of the most conservative target here. Now let me show you a couple of other gold against other currency first. This is gold against the euro. We also have this, again, assuming the most conservative ABC. We have a long way to go. We have a target towards 2,247 here. We are still at 1,637. So if you live in the euro, it is also, you will also experience gold continue to rally in the next few years against the euro, right? So again, people living in the euro is also gonna lose purchasing power, basically, because that is what it means when gold keeps rising, right? So people in the US going to experience a loss of purchasing power. People in the Eurozone also doing the same. People in the UK also in the same. You got an APC here still. Plenty of space to go to the upside in the coming years. Okay, and gold against the yen. This one also, this is the 2013 high. This is the 2018 low. It's been sideways for 5 years against the yen before finally breaking higher. So this one also has a long way to go. So if people live in Japan or any other country in Asia, they also will experience a lot of loss in purchasing power as well, and as gold continues to go up. So you can see gold is very strong against every single major currency in the world right now, not just against US dollars, right? In fact, US dollar has been one of the strongest currency until the last few months, basically, right? And finally US dollar starts to turn lower, the dollar index starts to turn lower, and that's when gold against US dollar starts to play catch up and then starts to rally pretty quickly, like accelerate the move to the upside, and then finally broke above that previous high in the 2011. All right, so again, the blue box over there is kind of like the most conservative target here for gold. Now okay, so this new high in gold therefore is consistent with all the other pairs of gold as well. Gold against euro, gold against Australian dollars, and so on. They all also make new all-time high. Now I think one of the sort of comments that I got here is the following. One of the argument is that this new high that we saw here is a wave 5, from all-time low. So people think that, okay, what about if this is the case? Something like this. Couldn't this be the case? Now if this is the case, then people say, all right, we're gonna be finishing soon. We're already in the wave 5, and then we can drop again to $800, right? Because you need to correct the entire 5 ways up after you have 5 ways up, and then you're gonna be correcting in a big 3 waves to correct this entire move, right? Now let me tell you why we think that's not the case. Let me tell you why. So only from technical point of view, right? I'm not going to be discussing about fundamentals or things like that. Even though if you want, I can talk about it, but we won't even talk about the fundamentals, right? If you want to label this new high as a wave 5, right? In Elliott wave theory, wave 5 is, it will be accompanied by a loss of momentum, okay? It will be accompanied by a loss of momentum in a wave 5. All right, now you can use any kind of momentum you like, whether you want to use we use RSI, relative strength index. You can use anything you like, stochastic and so on. But look at this move to the upside here in gold compared to this. It definitely doesn't have any momentum divergence, right? You guys know what momentum divergence is? Momentum divergence is when the price makes new high, but the momentum doesn't make a new high. It makes a lower high. That's what it means by momentum divergence, right? So in Elliott wave theory, wave 3 is going to be the strongest wave, the longest wave, usually the wave which has the strongest momentum, right? So wave 3 usually is the case like that. And then wave 5, like in this case, you can see here between this 3 and this 5, the price makes a new high, but the momentum does not make a new high. It makes a lower high. So that's what it means. Now if this is a wave 5 from here, the problem is even the momentum that we have right now is stronger than all the previous momentum here, as you can see. And not just in gold against US dollars. Take a look at gold against the euro. Look at this. This momentum right now is the strongest momentum compared to all the previous momentum. Gold against the pound. Because let's say if you want to call this 1, 2, 3, 4, 5, then you need to call gold against. So it cannot be that gold against the US dollar can be doing this, and then gold against the euro is going to continue to go up like this. Gold against the pound continues to go up. It's not going to happen. And that's what distinguishes us from all the other service and all the other waivers. We look at everything, not just gold by itself. Okay, we look at everything, and we know that if gold against all the other currency going to continue to go up, right? There's very, very unlikely that you can expect this to be a wave 5 and then suddenly you crash down to $800. So that's number one reason why it is unlikely. Is likely not a wave 5 from the all-time low. All right, so take a look at this also. So you got a divergence between this and this, so that's why calling this 3 and 5 makes sense. Secondly, if you draw a trend line from the all-time low connecting all this, you can also draw a trend line in the momentum as well. You can see this one broke below that trend line, right? It broke, right? So what this is telling us is this cycle is one cycle because it's sort of like one channel, and then after that it broke below it, and this is a new cycle. And that's why this is the right connector. We call it connector. This is the right connector from the all-time low. So this is not the same cycle anymore. This is not the same cycle anymore from the all-time low, because we got one cycle, we got second cycle that breaks below that trend line or below that channel, and then we got a new high after that. So this move is not part of the same move from here. This is a new cycle, and therefore this is either A, B, or this is 1 and 2. Your choice. Is it really A, B, or is it really 1, 2? Only time can tell how strong this move is going to be in gold. But this is one of the sort of arguments, at least from our point of view, that this new high is not a wave 5 from the all-time low. Okay, so the number 2 sort of argument that I receive from people in the social media is that this new high here, so they still believe that this is a wave 4, right? I think people believe this is still wave 4 from the all-time low. So the argument is something along the line like this. This took okay, if this took about 20 years or so this 1 and 2, right? So this one still could be, and this couldn't be like a 5 years move. So they say it's still within the wave 4 because it took 20 years here, and so therefore it has to be the same 20 years or something like that. So that's the same argument, right? That's the argument. And so they say, okay, well that means this is a flat like this, an expanded flat. So people say, okay, this is an A, this is a B, or maybe a little bit more upside before a B. Anyway, basically the argument is a B, A and B, and then we can get a C. So this is still a 3, right? And then you got a ABC in the lower degree. So this one, let's say, call it in the primary degree like this, ABC. So that's not the argument that I receive. Now, what is the problem with this? Well, in our service, right? In our service, we do not call a flat against a clear trend. Okay? That is kind of the rules that we use always. So, because the fact of the matter is, if you do not want to change, even though the market is proving you wrong, let's say you keep calling from the beginning is going to be doing this, and it doesn't do that. Inside it makes new high, and then you force yourself, no, I'm right, I'm always going to be right, this is a flat. Then basically you're forcing your bias. You don't want to sort of admit that, okay, the market is telling you otherwise, it makes new high, and therefore if you go with the trend, you have to really look at the other opposite side instead of forcing a flat. Flat is something that we in ElliottWave-Forecast.com never will try to force, especially when it makes new high or new low, something like this. Calling a flat is going to be, in our view, a less probability sort of scenario to happen. But let me tell you why we think that it is not a flat. Now the problem is with a flat, right? And this is what people sometimes do, waivers do not really look at it carefully. A flat, right? A flat needs to have a divergence as well. If you want to have an expanded flat, ABC, this and this needs to have a divergence. You don't have a divergence here, like I explained, right? You don't have a divergence in the momentum between this peak and this peak. In fact, this peak is higher even than this peak. This momentum in the 3 here. So that is telling you it is less likely that this is some sort of a flat. And then you have to compare with gold against other currency as well. Take a look at gold against the euro. Now, can you really, if you believe gold against US dollar is a flat and it's going to collapse, do you really think gold against the euro will keep going up like this? I don't think so. If gold against US dollar is a flat and collapse, the rest of the other gold pairs also going to drop quite significant, right? But if you look at gold against the euro, can you call this into an expanded flat when it has rallied a lot more than the previous peak? Even an expanded flat has a roll, right? You cannot keep calling expanded flat when it has already rallied so much more than the previous peak. You cannot insist this is an expanded flat anymore, right? This is not like a marginal high. This is a pretty substantial move above the previous high. This is not a flat in gold against the euro. So you cannot call a flat in gold against the euro. Can you call a flat here, A, B, C in gold against the pound? Absolutely not. It has rallied a lot more than the previous high. Can you call gold against the yen an expanded flat? Anybody wants to try that? This is ABC. I don't think so, right? It's not a marginal high anymore here, right? So that means, based on those observations there, we believe that we are in a new bullish cycle here in gold. It is not a flat from the 2011. It is not a wave 5 from the all-time low. So this has to be a new cycle. Now, if this is a new cycle, then like I said, the minimum target is going to be this leg equal to this leg. and that will give us 2970 3428 in the next coming years. Now, when is that going to happen? Well, the timing is always going to be an issue, right? It could be the next, I would say, as just an estimate, it can be in the next 3 to 5 years, right? The next 3 to 5 years, we can reach this target area here, right? So, okay, so I explained to you why we think that this is not a wave 5 and it is not a flat, and the conclusion therefore is that we have still a long ways to go and gold will remain a buy in years to come. So Manuel has a question, can it be W and X? It doesn't matter, even if it is W and X, Manuel, it's still the Y target is going to be equal to the W, even if you want to call it WXY. But it doesn't look to me, this is a corrective structure, to be honest, from the all-time low. This looks like an impulsive structure to me, so that's why calling it AB. So calling AB is the most, remember, calling AB is the most conservative view, because if I want to be more aggressive, I call it 1 and 2, and we are in the wave 3, and it can go all the way to 1.618, and that should be only wave 3 if I want to be aggressive, okay? But I don't. So I just want to be conservative here, right? As conservative as possible. What can we expect? No hype. So if no hype analysis, then we could possibly expect something like 2971, 3428 in years to come, okay? Alright, so let's go back to our presentation here. Now next, we're gonna take a look at silver right now, okay? So this is a monthly chart of silver futures. Now silver has a little bit different structure than gold. Very, very interesting, right? Very interesting. So silver here has a double top around $40, right? Now some charts show this high in the 1980 was at $50, but if I just look at it from our software using eSignal and basically try to look at the chart of the silver futures, the 1980 high was at $41. So there's a little bit of discrepancy there depending on which data, okay? It is recorded, Rita, so don't worry. I'm gonna post it very fast because I'm recording this, and when I'm done I will upload it immediately. All right, so don't worry about it. So this 1980 here, some data suggests that it was at 50, but then using eSignal I got only 40. But still, so you can argue that we got some sort of double top around $50 and $40 in silver, right? So this is the most conservative view, by the way, right? This is the most conservative view, calling this as a ABC ending W, and this is the X. So this year's low, because of that COVID-19 scare, was an X, and then now we could be looking for further upside to finish the Y. Now this is a logarithmic scale, that's why you see a little bit like the proportion is not really very nice, because I think it's using the log scale, but the equivalent of the WX in this case is going to be $60 to $90. Now $90 is 1.618, so I think let's say $60. $60 will be sort of the most conservative target for silver, right? $60. Now some people using the more classical analysis of the cup and handle pattern. I'm not sure if you guys are familiar with that, the cup and handle pattern. Believe that this is, you know, like a cup, the base from the cup, and this is forming the handle of the cup. And so if that's the case, then if we break above the neckline of this cup and handle pattern, you can, the target on the upside can be measured using this way. You measure the length here between your base to the neckline, and then you project it from the point of the breakout. Now if you do that, you technically can get around close to $90 to $100 as your target on the upside in the next few years, right? Again, this is a very long-term kind of view, okay? I'm talking about 5 to 10 years probably view here in silver, right? But the most conservative target I can think about here is just calling this as a WX, and then the Y equal to W is gonna give you around $60, right? That's, I believe, is the most conservative target for silver. Also remember, silver is probably the only commodity right now that has never broken above the 1980 price. Now some data suggests the 1980 price was at $50, so it's the same price as the one we got in 2011, around $50, right? So that means it is going to be the most sort of one of the most, I mean, one of the only commodities that has never broken above the 1980 price. Now, the 1980, there was an incident here called the Hunt brothers, in which there are this pair of people, the Hunt brothers. They try to corner the silver market by accumulating a lot of silvers, right? That's why you see a huge move to the upside here. But still, this is the only commodity probably that has never broken above 1980 price. Now think about it. What sort of things in the world right now that you can get in a lot less price than the price you have to pay in the 1980? Not really that much, right? Everything has increased. Whatever it is, the price of everything has sort of more or less increased. Now, of course, you can argue, no, technology has decreased the cost, like the car's cost has dropped and so on. But in reality, they always, like for example, the cell phone's cost has dropped. But yes, that is correct if you compare the old technology with the because they always come up with the new technology and they always charge more for the new technology, right? So even though the price drops, but it's going to be outdated by the time you're trying to buy. So it's not really the same thing. But commodity, on the other hand, whether you're talking about oil, copper, or anything else, platinum, they all have already broken above 1980 price a long time ago. Silver is the only one that has not done it, right? It's about 40 minutes ago, Amran, right? This is the only one that hasn't done it. So it tells you that there is a relative good value in silver right now compared to the other commodities. So that's why I think in terms of potential, I think silver has a lot of potential in my view. But then the most conservative target here, I believe, is this one. Now, if I want to be more aggressive, right, I can actually call this to be a nest 1 2 1 2, and then we are in the wave 3 of 3. Now there's a question, can it be also a diagonal from the all-time low? So maybe some sort of 1 2 3 4 5, probably possible, Kevin, but still that will require this move to break above $50, right? Even as a diagonal, you agree? Even as a diagonal, like what you're proposing, 1 2 3 4 5 diagonal, it still requires silver to break above the previous high. So eventually it is going to break above previous high, and my target $60 is pretty conservative considering the previous high was only $50. So I'm just adding, like only $10 more than the previous high, correct? So this is really very conservative, to be honest, right? Very conservative. Now again, there are a lot more aggressive view, like this could be 1 2 1 2. Think about it. If gold ends up to be not an ABC, right? If gold ends up to be not an ABC and instead 1 2 3, then by definition, silver usually in a bull market, silver is going to outrun gold. So it is not impossible to think that this is actually a 1 2 1 2 here if gold turns out to be an impulse, right? Eric is not my uncle, by the way, Lee, so don't worry about it. All right, so then this can go a lot higher than just this target here. I'm just using the most conservative target here to to show you what we can expect in silver in the coming years. All right. Okay, and then another thing I want to add here is that in my observation, in the commodities, and I do a lot of analysis in many different commodities, but I'm not going to talk about it too much or show you in the chart because I will not have enough time. But in my experience, when you have a new all-time high in the commodities, they tend to double in price. They tend to double in price. So in other words, you can expect, okay, let's say if the previous high was 50, both of them 50 in 1980 and also in 2011, they tend to double in price if you are able to break decisively above that. So you can expect, like I said, it's around $100. It's a possibility in silver, right? Once silver breaks to a new all-time high. So that's something that I want to add. All right. So again, this is more like a analysis long-term view. I will not talk about where can you buy, which level can I start buying, and things like that, because that's kind of different things, right? I'm just showing here in the analysis, sort of the long-term view, what we can expect, and all those things. All right. All right. So here, this is the gold to silver ratio. Now, as you can see, this is a very interesting ratio. Okay. Now, this ratio here is basically simply the gold price divided by silver price, right? You see that it has a perfect ABC equal leg. It tops out in the March during that COVID-19 scare, when people think it's gonna be so deflationary, right? So that's why gold rallies against everything else, against silver as well. But then since the Fed came to the rescue, starts printing money and all those things, and then starts to normalize again, the ratio drops tremendously again. So we reach the 100% perfectly ABC within this, rising channel, and it drops. It's very ugly. I mean, this is actually a yearly chart. It looks really ugly in a yearly chart. It looks like it's a massive rejection like this after and this 126 gold to silver ratio is the all-time high in the history. Basically, it never achieved the 126 ever. So this data goes all the way back to 1976, right? Now look at this. So we're going to be looking this ratio conservatively, looking to retest this lower channel here, the 61.8 retracement of the entire rally around 59. Okay, 59. So if you just, okay, at 59, the current gold to silver ratio now is 72, which is more like a normal ratio. In the past 70 years or so, it's around 70, right? It can go to 59 next. And if you just assume gold's price is where it is, let's say $2,000, right? Let's say gold's price $2,000. You divide by 59. So what you got is $34 silver price, right? If you will be targeting this 59 as sort of the next potential stop in the rise in gold and silver, because remember, when gold and silver price increase, this ratio tend to drop. This ratio tend to drop when the price of gold and silver increase, with the price of silver rising, outpacing the rise in gold. And then when this ratio rally, okay, usually that will be when gold and silver both drop in price. So when their price both drop, this ratio will increase, and the drop in price in silver is going to outrun the drop in price in gold. So that's how it works. So when we reach this 59 here, right? There is a possibility at this level, and I don't know. It depends on the timing, the exact timing. There's a possibility maybe we reach this level, 2950 in gold, when we hit the 59 in the GSR, the gold to silver ratio. So if we just assume gold hit 2970, right? 2970, you divide that 2970 by 59. That gives you $50. That gives you $50 of silver price, right? But we got a strong rejection after finishing ABC, and then now turning lower, and then I think 61.8 is going to be a reasonable sort of target here. 61.8 retracement of the entire rally. Now this GSR is a range instrument, so it's not like stock when you know people believe that stock is always going to go up, right? It will never go down. It will not never go to zero. They tend to always go up. Property price always go up over the long run. Of course, there will be correction, a crash, but then over the long run, it's always going to go up. Now, this ratio here, I believe, is more like a range. It's not going to be trending one way or another. It's just going to be a range, right? And I think we established a range now between 126 and whatever it is, you know, like 10 or whatever it is. So we're gonna be trading in a range now within, you know, that established high and lows in the gold to silver ratio. All right. How do you get the ratio? You can go to if you go to TradingView. I think a lot of people know TradingView, right? You can type in the gold futures divided by silver futures, and then you can get gold to silver ratio manual. Okay. All right. So this is to show you. Now this chart here is not from me. This is from Incrementum. This shows 300 years of gold to silver ratio between 1718 to 2020, right? Now this is very interesting chart. You can see in 300 years, right? Now when this chart was created, at that time the gold to silver ratio 108, but since then it has dropped to 73 right now, right? Very quickly dropping to 73. But when this chart was created, it was at 108, still very, very high and elevated, the ratio. But you can see in 300 years, the mean or the average is around 30, right? 30 is the mean, 20 is the median, right? Actually slightly below 20 is the median, and then the mean is around 30, right? Think about it. If we ever go back to, let's say, just the mean 30 gold to silver ratio, and just assuming, let's say, okay, gold stays where they are, let's say $2,000. All right, if gold stays at $2,000, and let's say the ratio can go down all the way to the mean in the last 300 years, which is 30, that how much will the price of silver be if that happens? That will be $66 in silver price, right? And that assumes gold's price stays the same. But in reality, when this gold to silver ratio drops, like I said, both the price of gold and silver will rise when that happens. So that means if, let's say, if the gold's price go to 3,000 or 4,000, and then this ratio can go down all the way to the mean 30, then you know the potential upside for silver is going to be a lot higher than the potential upside in gold. It should be in the same, because people say silver is gold in steroid. So when it goes up more than gold, like 3 to 5 times more than gold. When it drops, it also drops 3 to 5 times more than gold. So I think it works both ways, right? It works both ways. So it's good, but it's also very bad if they drop, right? So now the gold to silver ratio in the last 60 years, however, if you just look at it from, let's say, starting from 1940s, right? The average is around 70. So it depends on how far you want to calculate the average from. If you're just looking at the last 60 years, let's say, then the average is 70, right? The GSR average 70 is where we are, roughly is where we are right now, 73, right? But if you look at it more from a very long term, 300 years, then the average is way lower. Now another thing is the mining ratio. The mining ratio is the real ratio that you can get gold and silver from the earth, right? So how many ounces of gold can you get out from the earth compared to how many ounces of silver you can get out from the earth. Now that ratio, that mining ratio, is currently is around 10 to 1. It's currently around 10 to 1. So for every 1 ounce of gold that you can mine from the earth, you can get approximately around 10 ounces of silver, right? So I'm just giving you a couple of ratio as a reference, right? So if we ever get to 10 to 1, I don't know if we ever get to that, because that's the true mining ratio, 10 to 1. You can imagine, right? Like what can be in the price of silver if we ever get to the true mining ratio. But this ratio here is also one of those one of the arguments that silver really, the potential can be really explosive depending on how you want to look at it. But again, the presentation here assumes sort of the most basic conservative target that we are trying to achieve, which is only like $60, which is possible. Like $60 from where we are is almost double in price, which is 100% moved on the upside. All right. All right, now let's take a look at the GTX. This is the gold miners ETF. GTX, the ETF was launched in 2006. This is basically an ETF designed to provide investors to exposure to global mining, gold mining companies. Okay, so instead of you trying to pick which is a good, which company is good, and try to and then you have exposure, to that company. This is an ETF. It's like, oh, you diversify your position buying this ETF because it has several different global gold mining companies already. So this is also the oldest ETF, so therefore it's the biggest and the most liquid mining related ETF. It was pretty new. I mean, if you think about it, it was launched in 2006, so it's not really a long time ago. Okay, so if you believe gold is going to continue to go up in the next coming years, then this should also continue to go up. Remember, the miners are supposedly, when you play the miners, you're actually playing gold using leverage, right? Because they will have more cash flow at this current price. A lot of them are currently very profitable already. Now, especially after that massive bearish market in the past 7 years from 2011, a lot of these mining companies clean up their balance sheet and now are a lot stronger financially, many of them. So with this new all-time high in price in gold, they will perform significantly better compared to the past. So these miners here eventually also gonna go higher. Now I'm also labeling this as the most sort of conservative AB, and this one probably you can label this as an impulse here, so you can label this as a flat, perhaps an ABC type of scenario in which this is A, this is B, and then we can get a move, like a 5-way move here that will eventually break to new high above this 64 over here. Now you can see they are lagging right now because gold has already broken to new all-time high. The miners, however, still below the 2011 high. So this is going to play catch up. Eventually it's going to play catch up because the new price in gold is going to finally appear in their balance sheet. Their cash flow is going to be much better in the coming years, and therefore this should continue to go up, playing catch up with the price of gold, and eventually can take this out as well, take the 64. Now if you just look at it from the technical point of view, you can, people sometimes can draw this neckline here and it looks like again something like a cup and handle pattern or double bottom or inverse head and shoulder pattern, anything, you can label it in many different ways, and the minimum target here, if you just use that kind of analysis, is going to be the distance between the head and the neckline you project it from the point of breakout is going to be 51, but this can easily go above to new all-time high as it plays catch up with the price of gold. Okay, next up, this is the GTXJ. This is the Gold Miners Junior ETF, right? So this is sort of like the sister of the GTX. It is a market cap weighted index of the global gold mining firms, focusing on the small cap, right? So it's small capitalization companies. This one is lagging even more than the actual underlying price of gold and the bigger mining companies, the GTX. It is within the expectation because, again, what happens is in a bullish market, typically the price of the underlying metals rise first, and then speculation is going to start to come into the miners after the underlying price rises. So first it's going to go to the senior, so it's going to go to the big companies first, and then after that money is going to flow to the speculative areas like the juniors and the explorers and things like that. So it is typical. That's the rotation, right? The rotation of the money always from the underlying metals, and then to the seniors, and then to the juniors. So this one you can also draw the same neckline. This is a 7-year basing here, double bottom here, and we broke above it. We can still retest that trend line around 52, but then expect it also to eventually rally tremendously as well. Again, it can take this out, the 2011 high eventually, but again, if you just measure the distance between the neckline and the base, also you can just project sort of the minimum target from there. Now, that's a good question, Benny. How does it correlate with the? I believe right now. Right now, I think a lot of people still buying technology stocks, right? I mean, technology stocks are very hot, like Apple, Tesla, and so on. Well, Tesla is not even technology; it's like a car company, but it's now it's like a casino right now. But typically speaking, depending on the sort of the how the market performs, right? You can take a look at the ratio as well, Penny. So if you take a look at the ratio, let me show you. I believe in this next round, I believe the gold miners, right, is going to perform better than the stock market in general. And one of the reasons is the following. So first of all, I'm going to show you not the miners, but if you take a look, let's say gold futures divided by SPX, weekly chart. Now this is technically the ratio between gold and SPX. You can see they start to rise up here. So if this continues to rise, Penny, what that means is gold is going to outperform SPX. You know what I mean, right? Gold is going to outperform SPX. Now if that happens, look, gold against SPX. So if that happens, then the gold miners also going to outperform SPX. All right, the gold miners going to outperform SPX. Now remember, the gold miners come from a low valuation. It's still neglected sector right now. Now even though they are much more profitable and much healthier, so it's like a value play, right? It is a value play right now. Whereas if you look at a lot of like the technology stocks, Amazon, Apple, and so on, people can argue using valuation purpose they are pretty overvalued right now. Okay, so I think there is a place definitely for gold miners in your portfolio. So instead of putting all your money in technology stocks and so on, I think this value play is going to be catching up bits in the next, at least in the next few years. So it's now waiting. It's still lagging at this point. We are still lagging compared to the underlying price of the commodity, which is the gold and the silver price at the moment. All right, so that's the GTXJ. Now take a look at this Barrick. Now Barrick is one specific stock that I choose, not because I like this stock or anything, it's because it appears on the news. Because you might have heard about it. Warren Buffett bought this stock through his company Berkshire Hathaway. He invested around $500 million, right? And he was famous as saying that he hates gold. It's been, written that he verbally said he doesn't like gold. He thinks gold is useless because it doesn't give you interest, doesn't give you dividend, is very unproductive. Well, he is right, because gold is technically same as money, right? If you keep cash in your mattress, it will not give you anything, but you got cash itself, right? Now the difference between gold and cash, of course, is that cash is gonna continue to devalue. So every year you're gonna lose around like 2% basically purchasing power because of inflation, because of debasement. Whereas if you have gold, you maintain your purchasing power. That's the difference between gold and cash. Now, Warren Buffett buy Barrick, right? I think a month ago, I believe, the news, right? So this is sort of the possible count for Barrick. So currently it has already reached the 100%, but if it is an impulse, then of course it's not going to stop here, because it's not like an ABC. We still expect gold to continue to go up. So in an impulse, if you think about it, this count here is more or less quite similar to gold itself. It is a 1 2 1 2. If you remember here, it's slightly different, but this one from 2015 low, 1 2 1 2, and then going up. So Barrick should be the same. Barrick should be the same, and it can continue to go up in an impulsive structure, right? So this is more upside is going to be expected here in Barrick. Okay. Now that the grandfather of that people look up to, basically, Warren Buffett already invested in gold, then all the other hedge funds can start to follow, right? And there's recently there's news that the pension fund from Ohio also authorized to invest in gold, and it's a huge pension fund. I think it's a $1 billion investment fund or something like that. So so that's it starts to happen when institutional investors now start to look at gold as really another potential asset classes to own, right? Because it's currently not a lot of pension funds or hedge funds invest in gold, because they believe it's not really giving them a lot of returns. But with this current environment here, it's unprecedented when we got a lot of central banks printing money non-stop. Gold can be sort of like a good insurance policy, basically. So it starts to happen that people starts to own some gold right now. So this is Barrick here. Now next up, I'm looking at silver miners here, silver miners ETF SIL. This one was launched in 2010, and this is an ETF that is designed to track a index of companies in the silver mining industry, right? So this is equivalent to the GTX. GTX is tracking the gold companies. This is tracking the silver companies, right? And same as the GTX, this is also expected to eventually take out the high, and calling it as an impulse here, right? So we are still kind of in the early stage. If you think about it, we are still in the early stage, not too late, right? Not too late. And I think the key level for this one is going to be this 52 here, which is sort of like more like a neckline here. So if we can break above it and close above it, and so that will be sort of good for the SIL, and it can build a base from here and then continue to go up. But as of now, we are still kind of starting, not yet really. That mania, if there is a mania later on, is not happening yet. So it's still early stage right now. Alright, so this one, I'm just checking a couple of other individual silver companies here. This is a couple of famous one, First Majestic, Fortuna, Silver Corp, Endeavor, and so on. And I'm just checking that at this point, First Majestic seems to be the one that is most exposed to silver price. So this one, this company has 60% of their revenue, all right, coming from silver, right? So if somebody believes silver is going to be a better investment or is going to perform very well, then the company that is most exposed to silver is going to be benefiting the most of this bullish trend in the precious metals, especially in silver, right? So this one assumes a price of $18 in silver, right? So now the price is almost like double. It's like 27. So it could be actually it's more than 60% now. Could be 70% of the revenue comes from silver, right? So which means that if we believe silver is going to continue to go up to 50, 60, and who knows 80 and so on, then there is a good possibility that this a couple of these companies here are going to be doing very well. Okay, but again, this is individual stock. If you don't want to take the risk of individual stock, then of course ETF is going to be an easy way out. It's basically an index of a basket of companies, right? So the SIL is going to be one possible ETF for that, and there is another ETF called SILJ, which is the Silver Miners Junior. So the SILJ is going to be more equivalent to the GTXJ, which is the Gold Miners Junior. So that one is even more exposed. Now, if it really becomes speculative and become mania, then the money at the sort of the last phase or maybe the middle phase is going to shift to all this small cap and the juniors and the explorers and so on. And the money will come there because people want to get leverage out of the move in the underlying physical metal, right? So SILJ is also going to be perhaps an explosive instrument to capture the rise in silver. Okay, so I'm looking at the First Majestic here. So First Majestic, not that I like this company or anything else, just like Barrick. The reason that I show this is because there was a recent news about this, that a famous billionaire in the precious metal industry, Eric Sprott from Canada, he just invested $80 million in First Majestic just last week. So that's why I decided to show this, because just last week he did that. Just like Warren Buffett invested in Barrick, 500 million and so on. Now this one has been in sideways since 2009. Now granted, this company undergo a lot of changes in terms of the mine and so on, but still, just purely from technical perspective, it seems to be breaking out of this decade-old consolidation. And now this is as of last Friday, I believe. So it continues to hold. It retested that point of the breakout, continues to hold, as you can see here. So potentially, again, I'm talking about the next few months, few years, and so on. Potentially can continue to go up. If we assume silver price continue to go up, this can also continue to go up, maybe playing catch up, and potentially can break above this 2011 high as well. This is when silver price was at $50 at that time. But again, the company has changed tremendously now. They got more mines, they got more revenue, and so on. So you never know like what could be in the potential target on the upside here. Okay. So this is the First Majestic, calling this 1212 as a nest. So potentially can be pretty explosive. Finally, this is the Wisdom Tree. This is GCC. It's just an index for the commodity, right? Wisdom Tree contains commodity. Now you can see right here. Now this one we discussed this last year as well, in that webinar last year in September. This is one of the reasons we believe gold and so on will not go down anymore, because we reached the equal leg in commodity ABC. We've been depressed so much in the commodity relative to just stock market in general, right? That now is the time to start to break, and we are now attempting to break here. As you can see, if we break higher, then I think commodity rally has just barely begun. It has just barely started now, right? So 2021 and the next few years, it will be a great year for commodity. Now remember, if commodity goes up, and that will also be a transition to an inflationary environment, right? Now, the reason that a lot of people said, well, we printed a lot of money since the 2000, um, 2009 financial crisis, right? But there was never inflation in the past 10 years, right? At least according to what the Fed, Federal Reserve, measure as a, as an inflation using CPI. One of the reasons because a lot of those money didn't really come to the economy, but I think this time could be different because they do a lot of fiscal stimulus now. Like the U.S. government sending checks to people because of the virus and so on. So that money is being funded by the Fed and goes directly to people now. So this time could be different in the way that, okay, this time you can finally get the inflation because the money is not just being used, to in the bank and not really dispersed to the general public, but this time is directly given to the general public. Then we might finally get the inflation. So the chart seems to be telling that's going to be a possible case. So it's going to be transition to inflationary. Now in an inflationary environment, the commodity is going to be performing well. So silver in this case, because it is half commodity, half monetary, is going to be better than gold if it is really going to transition to more like an inflationary environment. Same thing with other commodities. Like oil can potentially also start to rally. Whatever it is, copper, and all the other commodities as well. Right. So we just barely begun here, if you think about it. All right. That's good enough, Eric. So I think with some patience, I think that can be rewarded very well. Now, this for the last sort of, okay, let me see if I can get it. Let me show you this chart of copper, right? This is the chart of copper. Now, no Elliott wave count, but just showing from a very simple analysis here. It has, like a almost like a decade old consolidation, and it broke above it. It finally break free. So this is supporting the idea, right? This is supporting the idea that it's going to be inflationary. So copper is recovering here in the price, and it's going to continue to go up, and that will be also supporting the idea that the commodity index, this is a basket of all different commodities here, not just copper, is going to also start to rally in the coming years. So that's the end of the presentation today here, guys. I hope you find it useful. Any other question here before we end the session? Now, again, we don't look at the short term that much, Lee, Robin, right? No, it doesn't contradict to copper because I'm not talking about the short term, right? I'm talking about, this is a bird's eye view here, right? Like for example, can GTX go? Of course, GTX can go down. I'm talking about GTXA can go down first. GTX can go down first. Why couldn't, let's say, I'm not saying copper is going to go up non-stop from here and no pullback whatsoever. No, it can go down here, retest this, let's say, before going up. So we're not talking about, like short-term movement here. Short-term movement is different story, but I'm talking about the general view, what we can expect, what's the right side of the market, the trend in the next sort of 5 years or so. Okay. I normally do the live trading room, Yun-sang, right? I am the host of the live trading room, so you will see me in the live trading room giving you an update and trade setups and things like that. And then Eric, there's a couple of other analysts as well. Eric will be doing the live session from the group 1. Daud will be doing the live session from the group 2, but I am primarily in the live trading room. Group 3, no. Group 3 will be Rob. So group 3 is going to be another analyst, Rob. Everything you have presented means US dollar is getting crushed, I'm guessing. Now, I think if you look at gold, Rob Hansen, I think gold is gonna crush everything, not just US dollars, right? It's gonna crush the pound, it's going to crush the euro, it's going to crush everything. So all the fiat currency now, they are in a competitive devaluation, right? So all of them is gonna drop in value, right? So it's not particularly just US dollar issue here, but all the world currency issue, right? How to join the group too? You can let me send you, hold on, let me give you the link to the free trial if you want to try our service. Somebody is asking. The Nifty will be covered in the group too. Okay, Arch. Alright, I'm gonna send you everyone the link to free trial. 14 days. Alright. Is it better to buy gold, silver against US dollar or the pound? It depends whether you are buying physical penny or you're buying sort of like paper, right? If you're buying physical, then probably just buy against the pound, right? You're just buying a paper, okay. I think they both are gonna rise in value, but I think if you buy against the pound, probably it's better for you, so you don't need to be worried about the exchange rate between the US dollar and the pound, probably, right? But I think they both should be going up. All right. What time frame is best to trade for intraday short term? It depends. I mean, what we are doing here is we usually are trend trading. So we identify the right side of the market and then we trade in the direction of the trend arch. So we can be trading the 4 hour or 1 hour and so on if the market gives us an opportunity. So really is it depends. Is there anything you can think of that would change your thesis regarding gold and silver? If the technicals change, Rob, then I will reconsider if the technicals change. But for now, I really do not see anything that is going to change my opinion right now. We've been correct in the past year or so, right? When a lot of surveys and waivers called this to happen, we said no, it's not going to happen. It's going to go up. When we were right, we are right. So it makes new high. Now some people now thinking it's going to be a flat or it's be flat. We say no, it's going to continue to go up. This is going to be the minimum target, right? So maybe we're going to do another webinar next year, maybe in September again, and see where gold is next year in September. Okay. Which commodity is going to be performing the best? It really, I mean, all of them are going to be performing pretty well, right? But it's really out of the scope of this webinar at this point, Amit, right? Because we're looking at gold and silver right now, in which we believe that they will continue to perform very well in the next few years, we believe. All right. Thanks a lot, everyone, for joining. And this session is going to be recording this webinar and will be posted shortly. And then you can find it if you want to watch again. Maybe you're late, you can watch the recording again within a few hours. We will be posted in our main website. All right. Thanks again, and have a good weekend to all of you.